Good morning and welcome to the Coffee and Cap Rates podcast, your go-to source for New York City's latest commercial real estate insights. This program is brought to you by Ariel Property Advisors.
Hi, everyone. This is Shimon Shkury with Ariel Property Advisors and our Coffee and Cap Rates podcast. And today I have two special guests with us. The first one is Victor Sozio, my partner at Ariel. Hi, Vic.
Hi, Shimon.
And the second is Matthew Swerdlow, who's our senior director here at Capital Services and places both debt and equity. Hi, Matt. How are you?
Doing really good.
Excellent. We're going to talk about the multifamily market and specifically the second quarter. What was interesting about it is what we saw growth in the dollar volume of transactions by about 25%. Even when you look at the last 6 months, we've seen more or less the same growth of about $5 billion altogether. Almost 2.5 for the second quarter. That's a 25% increase. As we know, we have three specific asset classes when we talk about multifamily. We have free market buildings, we have affordable housing multifamily, and rent stabilized multifamily, and they all behave very, very differently. When it comes to the free market world, we've seen a tremendous amount of growth in the fundamentals, continued rent growth, which pushed more investors into it. And one example that we have is an Avenue B deal that we just put in contract. It was a free market building. The amount of competition we had there was tremendous, and Vic can tell you more about that. And also more about the affordable and rent stabilized world. Vic, what have you seen in the past 6 months, and what did surprise you about the multifamily market as we stand here today?
So you touched on it, Shimon. It's a good news, bad news type of dynamic that we're witnessing here. You see that in Manhattan, where volume was almost $1.5 billion, there is inventory available that's either fully free market or predominantly free market, and that remains attractive to investors. You referenced 41 Avenue B, which had a tremendous amount of competition and depth of interest. Similar attractiveness exists in Brooklyn, where it does look like volume is down a little bit, closer to $500 million, so not as much inventory available, but certainly that interest remains, and those tend to be newer product or predominantly free market type of assets. But when you go to the outer boroughs, the volume remains anemic, right? We look at Northern Manhattan, where we only saw $90 million of trades in the second quarter, of which we transacted on a $45 million multifamily sale, which accounted for half of that $90 million. So really low volume when it comes to Northern Manhattan, and similar in the Bronx, where it was around 200 million, or Queens, where it was around 135 million. And you don't have to think too hard about what's happening there, right? These are predominantly rent-regulated assets, and that's the market that continues to struggle. And there's a lot of factors behind it. We've seen a rent freeze that happened or was formalized really in the second quarter. I think the second year of 0% increase caught a group of the market by surprise, and that had ripple effects in negotiations and pricing. And you have other factors at play too. You have interest rates that remain elevated, creating a chilling effect. And you have a lot of press and media that these investors and owners are seeing, where they're starting to become increasingly concerned about how violations come into play, and can it lead to a rent strike or an HPD judgment against them? And these are chilling effects. And it's not that there isn't depth of interest. This is still New York City, and I think there will always be a number for these type of properties. But what we're seeing is that investors want to be paid for that risk.
Yes, and I think you touched on specifically at the end on rent stabilized housing and the freeze. And that is just adding to the enormous amount of issues that are a result of the legislation HSTPA that took place. And today, the only way to increase rents is by the Rent Guideline Board. But what was also interesting to me to see are the two assets that our company sold that were project-based Section 8, specifically in the affordable world. And there is more private-public alignment, which allows it to trade and be more competitive. You want to touch on that briefly?
Sure, happy to. So you're right. So affordable housing in the second quarter accounted for about 220 million approximately of the 2.4 to 2.5 billion of overall dollar volume. So close to 10%, similar percentage that we saw in the first quarter. And then if you really look at those transactions, they were mostly project-based Section 8. And that's really the premier asset class when you think about what most affordable housing, institutional affordable housing operators and investors want to see. They do like the project-based Section 8 because of the federal subsidy component, and it's just a lot easier to operate and manage, being that, the voucher is coming from one source, really. So a lot of that volume came from project-based Section 8. As you mentioned, we were included in 3 of those, or we represented the seller in 3 of those transactions, and I think that will remain the case, right? That's where buckets of capital are still willing to be aggressive, really looking to solve for core plus type of returns, as opposed to the opportunistic type of returns that you'll see in the rent stabilized or predominantly rent stabilized or workforce product that's not project-based Section 8. What's interesting about the affordable housing world too, and we're working on a ton of these transactions, is that when it's not project-based Section 8, the best chance of a deal actually transacting and getting relatively good pricing for the seller is when a buyer can assume an existing capital stack, right? And if you look at the transactions that have occurred in the first half of the year, they were either project-based Section 8 and easily financeable by Fannie or Freddie, or it involved the buyer stepping into an existing capital stack and really solving for a good cash-on-cash return.
Right. So that's great. And I'll add that while the investors in the project-based Section 8 are making a good return, they're also making sure that the mission is there and tenants will live in great quality conditions. And by the way, the federal government and the local government make sure that that's the case as well. So it's a win-win and a very aligned process. And I wish we see that in rent-stabilized multifamily, but there is a lot of misalignment. There's no incentive in putting money into the deals. And as you said, there is a bunch of investors, but they're looking for basis. And with that, I want to talk a little bit about the financing and what's happening there, Matt. First, from a current borrower perspective, what's happening with people who have maturities in the rent-stabilized world? And then what do we see in terms of acquisitions?
Yeah. So if you're a rent-stabilized borrower facing down a maturity, the first thing you need to do is really get a good understanding of what your refinance proceeds look like and value of your asset. Because many times what we're seeing on our advisory assignments is that value has changed so dramatically that it really catches folks flat-footed, so to speak, and they're engaging their existing lender way too soon, close to their maturity date, and it creates unnecessary friction. We recently advised a client in the North Bronx who has 2 properties, 2 separate loans. We did an asset evaluation for him, and we told him to bring that information to his existing lender and see if they will have a conversation about a loan modification or an extension. Now, that value decreased very close, if not exceeded, the existing loan amount. And so the bank was very much aware and incentivized to work something out. And they're close to getting a agreement done to cure that potential default in a couple months because they started early. Now, on refinances, we're still placing many loans in the rent stabilized category. Specifically, Fannie and Freddie and CMBS are very aggressive in the proceeds department. We're routinely achieving 70-75% loan to value on refinances. On the acquisition side, we're also getting high watermarks. We recently just signed a term sheet to do financing for a 4-building package that we're actually selling of fully rent stabilized multifamily with a J51 that has a pretty healthy amount of term to it. And if we chose to rate lock today, we'd be rate locking at about 6.25, which is a fantastic rate given where some of the treasuries are today.
That's great. Thank you. And just one word about the free market world or the mixed income world where you have the majority of the units as free market, that's a little different in terms of financing, and I'm assuming a lot easier.
Definitely, and it's easier based on the size of the market. Your cost of capital is roughly going to be similar, but you're going to have a lot more bites at the apple when we bid out that type of assignment to a lot of the banks who are really looking to focus their lending in multifamily assets with 25% or less rent stabilization.
Thank you. And I'm going to wrap this up, but Vic, I wanted your comment here. We're got a lot of inventory in and a tremendous amount of asset evaluations where clients are asking us about pricing. It looks like we're going to have a pretty transactional second half of 2026. I wanted to see if you feel the same.
I do. And if you look at our contract pipeline and really what's even happened over the summer months here, we've had a lot of contracts signed, and those signs point to a more active third and fourth quarter. So I do feel that's the case. And you might want to fact check me on this, but I do think that we predicted that the second quarter would be between $2 to $3 billion of multifamily volume. I think the third and fourth quarter will be at least that. I think there's a puncher's chance that we could exceed $3 billion in one of those quarters if certain things close this year. So it has been active, but if you really look into the details of those contracts, what you're seeing is that some of them are rent stabilized. Look, we put a good amount of rent stabilized under contract in the past few months. And it's not that there's a lack of motivation or willingness from the sell side. It really boils down to, are they able to transact? Is there a loan? Is there a lender that needs to be involved in the transaction or give a discounted payoff in order for it to transact? But certainly we're seeing a lot of motivation from sellers to move on from these assets. But sometimes the gating issue is what the situation is with their debt.
Thank you, Vic. Thank you, Matt. It looks like we're going to have an active second half, and I really look forward to it. Appreciate you spending time here on this podcast.